Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for the week ending Thursday, April 9th, 2020. Remember, tomorrow the U.S. markets are closed for the Good Friday holiday, so we'll pick things back up on Monday. A lot to cover here. We say it won't be a long video, and I'm really not going to cover many different things, but what I am going to cover, I think is important. So I think this is a video worth watching, and we'll start out here with the equity markets and start with SPY. That's our official short proxy right now on the broad market directly. And so far today, well, we suspended the stop yesterday, and they managed to come real close, but not get it again. I reinstated it today, and I left that there as we're heading into the close. We were good. We closed the day at. Let me go here to a daily chart. Looks like the close is at 278.22, so we're okay there, close, but no cigar for those. Not that they're going after my stops. I'm not certainly big enough, or any followers on the site what we do big enough to move the S&P 500. Maybe tiny little penny stocks, but I don't do that. Stay away from those pump and dump sites that promote penny stocks. That's a lot of dirty shenanigans going on there, front running and all that kind of stuff. So right now we're sticking mostly with liquid stocks, or the ETFs, of course, SPY. And all I can say to that is the technical case, everything that I've been saying for this week is still intact. We did close up 1.5%, but again, considering the scope of the moves, that's almost nothing. And more importantly, which I'm about to get to in a minute, I'm seeing tech lagging behind now, and that's what I suspect may be the case on the next leg down. The Fed is, I'm going to just digress here fundamentally again. I've been doing that a lot lately. The Fed is coming in with all everything they have and then some, meaning they're literally going to Congress. They're trying to get money they don't have, throwing everything at this market. They're coming at it much more aggressively and faster than they were back in 2008. God bless them. They created this mess. It's in their vested interest to make sure it doesn't get worse. And it's one of their mandates, price stability in the economy. But again, if I said this earlier, some people might say, why fight the Fed? I've cited many examples in the past, all the way going back to 2000, the year 2000. I think it was 2000 or 2001, after the dot-com bubble had popped. Talked about the Fed coming in with an emergency rate cut of 50 basis points, just as they did a month or so ago. And the NASDAQ at that point in time, early in the bear market, had its single best day in history. Went up 20-something% in a day. And from there, it plunged and went down. I think it was over 50%. I already cited those statistics. And I saw the same thing happen in 2008. When the tide has turned, if it has turned, which I'm pretty certain, it looks pretty clear, the Fed is powerless to control the direction of the ship once it's made a full turn. It's economy, the stock market's like a big tanker, super tanker. It's slow to turn, although this turn whipped it. Thing almost rolled over. It turned so hard. But what I'm getting at, the stock market and the bond market, which they're really trying to shore up, the banks, they're trying to shore up the financial system, which are really the banks and the credit markets. They're just too big. They're just massive amounts of money. And now what they can do is they can certainly cause knee-jerk reactions. They can certainly try to postpone and delay the process. But quite often that backfires when they do these things. Market participants say, well, what does the Fed see that I don't right now? Why are they coming in today with that $2.3 trillion in credit facilities to try to shore up the credit markets after LQD has been rallying already, and the stock market's been rallying? Again, they're not taking any chances, and they made that clear. But I'm thinking they see, a lot of, they have a lot to worry about right now, and rightfully so. Everything I've already gone over fundamentally, so we're not going to revisit that anymore. Just want to go over the charts here, tell you that here's that wedge on SPY. And let me tighten this trend line up. Sometimes these things move around when this chart flips over to after hour trades. But there it is. It's like right there. So we have a breakdown shortly before the close today, below this bearish rising wedge pattern here. We're on the 60-minute chart. This is the official trade for SPY. There's our price targets. And again, we closed below that suggested stop today, so we'll have to pick this up next week. and see where we go from there. But I still maintain those targets. I still think they're likely to be hit. Now let's look at QQQ. All right, so we're a SPY. The S&P 500 was up about 1.5%, thanks, of course, in large part to the financial sector. And of course, that is, they were the biggest beneficiary. XLF was up 5.36% today. So the move that you're looking at in the market today, I'll tell you the sectors that benefited. XLF financials first and foremost. And that is I think it's still the third largest sector, unless these numbers, these have changed. I haven't updated that in a while. You can see last time I updated that was on, no, I moved it. That's why it's showing an update. I created that on June 12th. No, I update it. Sometimes I'll go in there and I'll change the weighting. You can go to SPY, type in SPY ETF, and when you get the Google search, go down a few hits till you get to Spider's website, and they will give you the holdings in SPY, and it will give you the percentage allocations in each sector. That's how I get these numbers. So give or take, again, it doesn't matter up or down, probably down a little since I last updated that, but it was and has been for a while the third largest sector in the S&P 500, about 13%, and therefore a big lift right here from the shenanigans the Fed's pulling today. Obviously I speak a little bit ill will because I'm just a firm believer in free markets and capitalism and kind of hands-off market approach because again, I think they large part of why we have such violent moves down in the market is because of the excesses created in this with a decade-long policy of super low, artificially low interest rates and excessive liquidity, and allowing both corporations and investment funds, hedge funds, all types of funds like that, to leverage up. And so what you saw here is deleveraging of the system, a lot of forced margin selling, a lot of some over leveraged funds blowing up, and then the other sector that they came in today that again that the market assumes that their additional credit facilities are going to help were the REITs. Somebody asked about those the other day, gave you my opinion. We're probably looking at a nice short trade coming up in the REIT sector soon. I like to track IYR. It's been around a little longer, although DJ XLRE, the one I just showed you, is the that's the one run by S&P. So that's going to be closer to what you're going to see in the S&P 500, but you're going to have a lot of the same ones here. And this is the IYR Dow Jones Real Estate Index Fund, or ETF, coming up to a resistance level. And then what's interesting is there's all different types of REITs. You have hospital REITs, and I imagine they're doing good right now. You have all kinds. There's a REIT for the cannabis industry. I've traded that one and put it on the site before. It's a trade idea. Did very well when we used to, when I had a lot of long trade ideas in the cannabis stocks in recent years when they were starting to take off. And okay, I wanted to pause it for a second. I wanted to look up this stat. I read about this today. Earlier, I wanted to find it, make sure I got it right. Okay, ready for this? This is from the Wall Street Journal today. Nearly, no, this was actually this was a few days ago. It might be updated. This was April 1st headline. I couldn't find it. Just did a search. On April 1st, they reported, and I'm sure things haven't gotten any better since April 1st. Nearly a third of apartment renters did not pay any of their April rent during the month's first week. And so again, that was back on April 1st. I think I saw a headline coming out that's increased. And so what we'll be looking for are these guys here. There's a lot of you can either short IYR or buy SRS, and you're shorting the good and bad REITs, or you can target those apartment REITs like EQR, and they're all up today because of the creds facilities. They're able to, this is just, the market just assumes it's going to help everyone who's in distress. These are all I'm just typing the various apartment REITs out here, AVP, and you can see where they're rallying some levels. I haven't marked up a lot of these charts in a long time, and I'll do that. And I'm keeping an eye on these. I don't think the time is right for those. That's why I didn't add any of these today. But I just wanted to make mention, okay, if that trend continues, if we've already had, nearly a third of renters that didn't pay any rent that, previous week, you're going to see that increase. So probably not a good time to be a landlord right now, especially things like apartment buildings and all that, where you have, you're going to have a good number of people that have lost their jobs. Just food for thought there. And, like everything else, bear market rallies are certainly impressive. So don't ever judge it on just the percentage gains. You just have to put it relative to the previous move down. The percentage gain, again, is only, significant when you measure to the drop down before, and that's where Fibonacci's will help. 50% right there. We're a little bit above the 50, but still shy of even a run-of-the-mill 61.8 retracement level. And that's also going to be resistance, very nice resistance on UDR. I should have a line there. And again, I don't want to go off task here because I could talk all day on all the different setups that I'm watching, things like this. I'm just showing you a few more residential REITs, the apartment REITs. These REITs have a good exposure to apartments. Okay, back on task. Let's get back to the markets. So I'll just toggle over. I'm flipping boards here. This is a messy one. Should have all these lines off. But what I want to show you here on QQQ, this is a 60-minute chart. I went to this board because I already had some fibs up. This line here, Fibonacci retracement from the all-time highs in QQQ down to the lows, and you can see where we've stalled out. I mentioned that the other day. You can't even see it here because I had a price resistance level at 201.28. I'm going to remove that or just move it up here, and you can see underneath there is a 50% Fibonacci retracement level, and that's where we've been stalling out so far. So again, maybe I'll be proved wrong. Maybe this market's going back to new all-time highs or back to run it, test the highs. That is a possibility, but as of now, nobody can say with any degree of certainty that this isn't anything more than a run-of-the-mill, bear market or counter-trend rally, because we've retraced 50%. And again, I did want to point out that the Qs are weak today, and as I suspected we'll start to see, is right now, again, if you back out what happened today, and that is almost exclusively those gains, because I'm looking at the sectors in the S&P 500, and as I said, when you look at the other sectors like tech, for example, was almost flat today. So the big gainers were the ones that will benefit from the cred, trying to extend liquidity and give a lifeline to a lot of these companies that otherwise would choke and die without the credit, and that includes, of course, the banks. They're always going to be a big beneficiary of the Fed printing money or backing them to loan money. That's what they're supposed to be doing, and the Fed's pretty much going to backstop the banking system just as they did before. And you know what, they have to. If the banking system collapses, everything else in the economy will crash. They've created these too big to fail monsters. They had a chance to end that during the last financial crisis, but they chose not to. So they're on the hook for making sure that the big banks continue to prosper as before. So okay, so what were the fund managers stealthily selling today? That's what they do during bear market rallies, or even during a bull market rally when they think that the end is near. They will sell what they want to get out of. They'll sell into strength on days like today when everyone's looking at the market rallying and buy. Individual investors are buying the SPY, flooding in, things like that, and so they're using that that buying pressure to unload things where it would be much harder on a down day, and one of those were semiconductors. So here's one more of an example of here. Let me pull something up. Here's what I want to show you. An example of being diversified and not putting all your eggs in one basket. So the way to look at this, I just sorted these in order, alphabetical order. So Berkshire we shorted, but we shorted it today. And looked. So let's just say we're flat because we just shorted it. Berkshire was up, but we didn't come into the day long. Corn we came into the day with as a long, but we were flat. So no, we don't put a plus or we'll just nothing there because we were flat. Costco we came into the day short, and for the reasons I cited before. They announced last night that they're pretty much selling their low margin items, and profits were lower than they expected because nobody's buying the higher margin, more profitable stuff. So we get a check mark there. We were up about 2% on our trade because that's a short trade. Gold, we were up about 2.5%. LQD, they got us there for sure, and that was the direct bullseye for the Fed. They're targeting that corporate bond market for the same reasons I am. So, basically it's little man me versus the Fed. But I think over time, as I said earlier, I do not think the Fed, the bond market, corporate bond market is just too big. So you're going to get one day spikes like this, and that's why I pulled the stop today and decided to go home. Let's see how this thing follows through next week. It's not uncommon. In fact, you'd almost expect to see some kind of pop like this from an announcement like that. And again, it's unforeseen. So like I said, they caught us and we had no choice but to either take a loss at the open or suspend those stops that we pretty much traded around that where we opened all day anyways. And so, worst case tomorrow, or worst case on Monday, maybe we get stopped out for a little additional loss. But I do think there's a very good chance that that pop will be faded, and then this trade will ultimately go on to become profitable. And if not, then it's one of many, and you shouldn't have all your eggs in one basket. Palladium we're short, so that's another check mark today. Sugar we are long, and that was down 0.6. So we can put a check mark there. We can say 0.6 is essentially flat. SSG, there's our semiconductor short. So yet market was up today, and yet we were up almost, we're up about 4.5% on our semiconductor short there. And then Verizon we just shorted today as well, so that one doesn't count. And the just a quick update on that MNK trade, since someone first brought it up the other day. This is one I first highlighted couple weeks ago, right about here, and we hit that second target. I had a sell limit order there at 3. Let me see here, trade log. Yes, I had a standing limit order to get out of there, and I'm out of that one. I just want to say I think the run's over, and that I think today's move helped them. I got to go to another account. I'm looking at a different monitor. MNK out at 393. And that because I wanted to set, I always tell you, if it's an unofficial trade, don't hold out for the last penny. That's resistance. You had a moving average there as well coming in. And, if all eyes on 415, I'm not going to hold out for that. So, yeah, I had a limit order at 393. Looks like we had a high of 396. So I'm out of that. That's a big resistance level. Look at all the reactions right there. Now, it can very well go up next week. If it does, it's probably because the market's rallying. But this is also a fly under the radar company. This is not an S&P 500 holding, so it can do its own thing. If you're in it, all I'd say is you can set your stops and trail it up there to that final target I gave you. But this one so far, I can't remember exactly where we went in, but we're over double on it, double on our money right there. That's about 123%. I know we took it before the trend line, and that's that. That was an unofficial trade. Let's see, and back to the official trades. LQD, I did plenty of updates on it today. Gave you my thoughts. This stop will be reinstated on a daily close on Monday to that 131.10 level. And again, this is just a lot of traders being caught off guard. But here's the way I want you to look at this, the way I see this. I already gave you my fundamental thoughts. The same basis made when we shorted this one twice before, profitable on both. We did the first short right here before we even broke down. That was short number 1. For those of you who are new to the site, we shorted right here on that day, if I can get the right tool here, on this candle, in anticipation of a breakdown, wrote it down, closed it somewhere in here, sidestepped that first big kickback rally, then reshorted it there, wrote it back down, not all the way to the lows, but somewhere in there, and then exited, and we reshorted here recently at 122.77. So this is where the Fed got us today, or not yet technically, but they certainly took it against our position, and because we're at I think it's about a 6% loss, a little better than that. And yes, it is a 2-time position size, because typically corporate bonds have extremely low volatility. I mean, this is, you short corporate bonds, these are what grandma buys, instead of her CDs or with her CDs. And we've never seen this before, I don't believe, in the history of corporate bonds, at least not in the many decades I've been around. So We'll see what happens. Now, look at it this way. Okay, this was the all-time high right here in LQD. Corporate bonds had never been at a higher price. At that point, you had virtually very little, if any, upside, just like treasuries, because interest rates on corporate bonds are not going to go below zero. They were almost there. They weren't there. They're a little higher than treasuries always, but we have very, very little downside in rates. The upside potential for bond prices are minimal from that point, or were minimal, and because for corporate bonds that continue to go higher, you have to see rates go lower. So we're back to where we were before, where the risk reward alone was good for shorting bonds. And now look at where we're at from the all-time highs. Okay, this is when the economy was booming right here, firing on all cylinders, right? It just seemed like a long time ago, but it wasn't that long ago. And here we are today. Let me try to measure it again. We closed the day, and this blows my mind. We closed the day 1.8% or so, less than 2% below the all-time highs in LQD. So at this point, like I said, I would, if I didn't practice proper money management diversification, I would load everything I had onto shorts on these and sit on those and hold them, because there's virtually no more upside for corporate bonds. And the fact that they're back to where they were, with the economy, the U.S. economy having, a good part of it shut down for the last several weeks, last month or so, with an undoubted plunge coming in GDP for this quarter and probably the foreseeable future, this just blows my mind right here. And this is, again, it is the fact that the Fed's coming in aggressive trying to buy up these bonds, but I believe they cannot stave off the inevitable. And so you have two things here. If they happen to save this whole economy, and let's just say coronavirus magically disappears tomorrow, right? Coronavirus starts going away, whatever, they find a cure, and they're able to get it out to everybody in short order, and everybody goes back to work, and everything is hunky-dory as it was a few months ago. If that happens, what you're going to see are interest rates skyrocket. The Fed has brought them down near zero. They're going to have to take back those cuts because they'll need that wiggle room. If the economy was firing again on all cylinders, they have no reason to be at a zero interest rate policy. So it is, again, the same thing I've been saying for a while, a catch-22 here, or a no-win situation for corporate bonds, because corporate bonds at almost all points in history except the last couple months, the biggest determinant of corporate bond prices, the biggest driver of corporate bond prices are interest rates. It's that simple. When interest rates are going lower, corporate bond prices go up. Investment grade. I'm not talking about junk bonds, only investment grade, what we're talking about here, just like treasuries, and vice versa. So what happened here is rates were going down and corporate bonds were going down. Extremely unusual. Very few points in history have you seen that, and you've never seen a drop like this in corporate bonds, especially concurrent with a drop in interest rates. That was a race for the exits out of those bonds because of the sudden shift in the economic outlook and the downgrade in credit quality, everything I talked about. So now going forward from here, either the economy gets better and rates go up, in which case these bonds, if they stabilize the prices and the credit, the risk of downgrades in those bonds, those lower quality BBB bonds having to be sold out of LQD and all the other mutual funds around the world that have to hold only investment grade bonds and must sell them when they're downgraded below BBB into junk status. So if that risk goes away, then you have rising rates, and you're going to see the bonds fall for that reason. Otherwise, you could see the other thing is, if the economy continues to get worse, not better from here, you will see whether or not Moody's and AM Best and Fitch go ahead and downgrade these bonds, as they should be right now, downgrading the credit ratings. You'll see the fund managers use this pop to get out of those bonds. They were giving anybody in investment grade corporate bonds, including hedge funds, pension funds, etc., were given I think a golden opportunity today. They didn't see this mess coming back there like we did, caught it, and profited from it short. They were trapped in. We can tell by looking at this chart. A lot of institutions and individuals were trapped. Well, they've been given a second chance, and I think they're going to take advantage of it. Fed's going to try to stop that from happening, but again, they're going to end up holding all the lower tier bonds. And I read this the other day, and I don't know if it's true or if it's going to be changed, but the Fed is only prohibited to buy investment grade, high quality bonds. They cannot buy junk and lower tier bonds. So I don't know if they're going to be allowed to change that and pick up these triple B and the bonds that are going down to single B rated. That's yet to be seen. I'd really have to look into that, and I'd welcome feedback from anybody that's maybe an experienced bond trader or works on Wall Street and understands if they are going to be able to go in and prevent that massive slide from the triple B issuance that's within the triple B bonds that LQD holds down to what happens to all those bonds if and when they start getting downgraded to double B or lower. And of course, forget about all my fundamental ramblings. Let's just look at this like any other trade, whether we were trading XYZ company that sells widgets or LQD. And what I see is a beautiful back test of a very well-defined uptrend line, the same basis for this trade before. Breakdown back test. Yeah, it's really big, but the bigger the move here, most likely the bigger move coming. And again, it might not be the waterfall sell-off that it would be if the Fed hasn't come in with everything they have to shore up this part of the market, because this is big. This trickles down. Everything is all intertwined. A vicious cycle. If the corporate bond market collapses, the banks collapse and everything else, and the whole financial system will come to a halt. So the Fed's going to probably try to prop things, and I'll just leave these targets on for now if we're not stopped out. And look, if we are, something else is going on. Maybe the Fed wins. If they can get this up here and pop it to new highs, they're at least for the near term they win. And then believe you me, if they get me out of this trade, I will keep an eye on this one and wait for the right opportunity to re-enter that. I think you guys know that about me. I'm pretty tenacious. If I on a security or stock then the technical and the fundamentals are very clear that it's going one way. Sometimes there's a little delay in that process, and sometimes things might look to be setting up like the best trade in years, and then all of a sudden the charts and the fundamentals start to dissipate. In other words, what I was seeing before, I can't make such a strong case. And where would that be? Well, here from a technical perspective, if we take back the trend line, I can't even say if we take out the new highs. As I said, I do feel confident that the upside is very, very limited. So here's something, again, you could be short here, and the most you're going to go underwater, although I can't make this guarantee, is a few percentage points. So at best it might be dead money, or worst it might be dead money for a little while. And then when you are short and anything that pays a dividend like this, they pass along the interest, although it's not very much on these investment grade bonds. When you're short, you are responsible for any dividend payments on the security that you're short. Okay, next up, gold. It's all part of our asset allocation diversification process here. I'm working hard to get a mix of trades on here. I might sit here, talk the bearish talk all day long, but at the end of the day, I'm going to cover my bases, because I know at times I'm going to be wrong and at times I'll be right. So spread my bets and try to do the same with the trade ideas on the site. So gold, I posted an update right around the close today. I did mention earlier in the week when I was doing a video, we had hit T3. Remember, I have a fourth target I added recently up there at 172.55. It's pretty high up, and we're at multi-year highs, so it's kind of off the chart there. It's a longer term bull market target. It's based on really an outlook I've had here for a long time. I've been bullish on gold, mostly long, but pointed out pullbacks and shorting ops along the way. But it's been in a bull market. You can't argue that. No matter how bearish you are, you can't say the gold's not in a bull market. And there's your bull market right there since 2015, late 2015. And so, I think next bull market target is up there around that 173.87 level, and that's where our next target is set, somewhere up there. So Like I said in the post day, what's the good and bad? Well, we have negative divergence on all time frames from the 60-minute chart out. So 60-minute daily and this weekly chart. We're looking at negative divergence. Remember, we had divergence here, and there's a couple things to this. So we already had a divergent high, and that was pointed out here, and it led to a big correction. It was a drop of about 14% right back to this 137.20 level. That's where we scooped it. We picked it up there, and we've been long since. And we had trades along the way before that. Now where we're at, we're pushing at the previous highs, and so you on the cross currents you do have the negative divergence, and as I often say, breakouts that occur to all-time highs or new highs with negative divergence in place have a much higher failure rate, and I usually stand back and don't take those. Now we're already in this position. And it's also what I categorize on right side of the chart, not just a swing trade, but it's also the additional category called a long-term trade idea. Those are trend trades or investments for you, longer-term investors, 401k stuff. This is where, I think, 401k buyer would, like I said, all along waiting for a pullback, and that's where, I think if you had it or looking to add it in your 401k or IRA, that's where you could add it back, and so far so good. We're up whatever it was today. I did the math. I forget, it was about maybe, I don't know, 16%, I think, 12%, I'm not sure. But where we're at now, we're pushing against those previous highs, and I showed you that earlier today on the 60-minute chart of GC, but I didn't point out the divergences at the time. And so as I said in that post, I don't want to expand on this too much in the video because I've already put it down in words there. I can't tell you with a high degree of confidence which way this breaks. Normally, I might be looking to short gold, but number one, it's in a bull market. And because of that, what happens in bull markets is a lot of times divergences can get burned through. You can see the divergence. It looks like a nice setup, but we burn through it. So that's number one. Number two is the fact we've already tested this level several times. This was the first time we came up to that 170 or 1728 level. We had the same thing, and it was pointed out at the time. We had negative divergence right here. You can see it. Divergence on the indicators, and that did lead out for big correction. We came up, hit that level again, and rejected once more. We came up, hit it again recently, but instead of having a sharp rejection like the previous two times, we had a little pullback. And so what gold's been doing here, it's kind of building up energy. And I mentioned before the other day this potential, I'm making a mess here for you, but a potential inverse head and shoulders pattern. A lot of traders will watch these. They should be bottoming patterns. That's at least historically what they were used for, but a lot of traders watch them as continuation patterns. And so we broke out today, but we closed right back on that level to back test. So from the bullish point of view, I can say this is a breakout and a back test. That's an objective long entry. And what you can do is I showed you on the chart I posted earlier. I had a line here. I have to add it back. I drew it in with the screen capture software afterwards. So I can say that it is objective here. You might want to wait and see how things trade when we open up next week on Monday for GLD, or you can watch gold futures over the weekend. But there would be another objective long. If we fall back in there, you have a trend line support, and a lot of times you will break out the new highs, take a breakout level, and then fall back. And that what they do is they shake out the weak hands that took that, so they think it's a failed breakout. So it's not unusual after a breakout to back test and come a little bit lower, but you don't want to see gold or GC, gold futures here, go much below this uptrend line. And so therefore, again, it's objective because you can take it with a minimal stop, minimal loss if you stop out below that level. If that does go, here's your next support down here, 1673, and so forth and so on. So that's it. We'll see if gold can power on up next week and go much higher. And I think if that does happen, that will most likely coincide with a drop in the stock market. So where I'm going with this is I talked a lot on one of the trades today that I laid out there, whether it was Verizon or Berkshire, how I'm adding some individual stocks on now as short trades. But remember, I'm either going to be right on where the market's going, and then I'm going to be right on Berkshire and Verizon, or I'm going to be wrong on both, because Berkshire and Verizon are top components of the S&P 500, and they're not going to hit those profit targets. I can all but promise you that trade will not be successful, or those trades will not, if the market doesn't drop roughly that much. So Keep that in mind with your position sizing, because diversification, if you have 10 positions but your 10 positions are Amazon, Microsoft, Apple, Facebook, Berkshire, name all the top components of the S&P 500, and then you have SPY and QQQ, guess how diversified you are? Virtually not diversified at all. You have the same stuff. You have some ETFs that are indexed and chock full of those names. So that is not proper diversification. That is overlap in your positions. Proper diversification is things such as gold, bonds, maybe some currency ETFs, individual stocks like MNK, like I showed you earlier, that don't have a correlation to the market. But in this case, there's a good shot that where gold goes next week, as I said, in the next couple weeks, will probably depend on the market. If the stock market starts to correct hard next week, you will probably see gold can break out and run from these levels. If the stock market continues to rally, then this will probably play out. You'll probably see money coming out of gold because it tends to be a flight to safety asset, and that may break down. So wish I could tell you which way it's going, but what I can tell you is, one will probably know if we see these support levels give way next week, or we see gold continue to build on today's gains, take out, put these recent, put that 1728-ish level in the rearview mirror, and then go on to burn through these divergences right here by taking out those previous highs on the PPO and the RSI. Well, at that point, you no longer have the negative divergence. That would be the bullish case there for gold. Okay, and to bring the video home, let's just look at the stock futures and we'll wrap it up. I already covered SPY and QQQ, showed you the negative divergences. So you see basically the same thing on the stock futures. This is ES, the S&P 500 E-mini contract. We're looking at a 60-minute chart, and just nice, clean, bearish rising wedge patterns. You can see we had a price channel here, a nice, clean, tight ascending price channel. We broke down, gave us a sell signal, fell back to this pretty important support level, which held 26.26. That was a big level. The fact it held, and we pushed up. However, we've set up into an even larger pattern with clear negative divergence in place as well. And last time we had negative divergence during this bull run here was right here. That led to a nice drop there. And more importantly, now we're back then we weren't at my uppermost bounce target for ES, and this time we did hit it the other day, or at least on SPY. And so there it is. Keep it very simple. So you want to see a solid break below this wedge pattern here, this uptrend line on ES. If so, your first target, well, you can see the first target here. It's minor support, but the big level is 26.26. I think if that goes, that will be a failed breakout. I think a lot of short interest was cleared out here, and a lot of longs piled in, thinking maybe the worst is over. So that's a big level I'm looking for. First, the break of the wedge. Minor support there, and then 26.26. If so, that should open the door up for a deeper move down. May happen fast, or we may continue to grind around. That is something I predicted about 2 or 3 weeks ago, that back here, that would likely grind around in the market for a while at this point, based on where we are in the cycle of things. We hit the first leg down. We've hit what I believe to be about the maximum bounce target, not the maximum, but the ideal bounce target where I thought the markets might go to the high end, but we hit it more so in price, not in time. It's been a really quick, you look at previous bear market rallies, and they usually last a little bit longer. But so I don't know how to process that, because the initial leg down this time around was a lot faster. So everything seems to be happening in sort of with fast forward button hit on 5 times speed, maybe 10 times speed. Either way, we'll let the price levels be our guide. It's hard for me to predict exactly how it's going to play out. Somebody even asked me that on the Berkshire trade today, when I think those targets will be hit. That's below that trade setup on the home page. You can see my response there. I gave a time frame on the first target anywhere from a week to, I think it was maybe 6 weeks, and it all depends on how things happen over how quickly any developments happen. And let's see, remember, we have a 3-day weekend. Markets are closed now for 3 days. So we're going to hear what's going on with coronavirus. My guess is because it takes a while for everything's lagged behind a little. You're probably going to see an abatement in the number of cases and deaths. We did see some of that yesterday, I believe. But again, as I talked about, that's a catch-22 for the market, because that's due to quarantining and social distancing, whereas you start to see an abatement in cases, and sure enough, people are going to go back to work. They're going to start going to the beach and doing all those things where they get in close proximity, and then boom, you're going to see the cases surge again, unless there is something that stops the spread of this virus. And then there's NQ, almost identical. I have this trend line here drawn this way. I think it's a little better fit than coming off the lows. You could probably do both. Oh, actually, if I do both, I'd probably come up with that. That's where I think the previous trend line would be. But yeah, well, let's just leave this one here. There's your negative divergence right there. Very clear divergence at this point in time. We had divergent high there, correction that went on to become an even larger divergent high with an even larger correction. And so, boom, break of the trend line should take us down to 79.52. Pretty big support, comparable to that important support level I just said on ES a minute ago, where that was a breakout. I think cleared out a lot of short interest, and so if and when that level goes, that would be even more bearish and probably open the door to more downside there. And last chart of the video is RTY, only because I posted an update this morning, and the charts I'm watching at that point in time, we did have a small wedge, which just basically extended a little bit. I had it drawn like this. We popped up, and we still have the divergence on the RSI, slightly higher, almost an equal high on the PPO. So this is where we draw the lines right here. More importantly, those are just divergence lines at the top. I don't consider those price trend lines, unless you have a price channel with a lot of reactions on it. But a divergence line, I only take 2 points to show the divergence there. A trend line, I have to see at least 3 reactions to validate that trend line. So this is the price support level. Divergence line is not necessarily a resistance level, if that makes sense to you. Again, a price channel line is if you have an overhead level because you have multiple reactions. But on a divergence line, as long as prices are going up and the divergences are intact, I will just move that line up until and unless we no longer have the divergence. Then I don't put a divergence line there. All right, let's wrap it up here, and we'll see where we pick up on Monday morning. We'll watch the futures on Sunday night, and if anything dramatic is happening, I'll try to post an update Sunday evening, or most certainly well enough in advance on Monday morning to give you guys a heads up and give you some levels to watch so you can have a game plan for next week. This has been Randy Finney with Right Side of the Chart. Have a great weekend.